A COVID perspective on finance. It is still hard to believe a decade ago that I was working in finance as a clean-cut, suit-and-tie business guy, especially since now I have long hair, ride a bicycle, and make pyramids with crystals in them. I'm sure most people thought I lost my mind at the time, and many might still believe that. However, finance was great until I ended up learning too much. Then everything changed. I had to be true to myself, and selling products for a fundamentally broken system was not my calling. I hope to share some of my personal experience to help others during these times of high financial stress, while also sharing some interesting perspectives about finance. To start, I initially began by running my own financial office after the 2008 crash. I decided to get involved in finance after I turned $1,500 in stocks into $20 through a series of incredibly bad trades. Sadly, I was not very successful as a financial planner either, as I learned most people in the world were broke. However, I was very successful in helping with debt management and helping to educate people to get back on their feet. The statistics a decade ago were 50% of Americans are 2 weeks away from being homeless, meaning that today many people without help are technically homeless. I was faced with that stark reality a decade ago, and it was eye-opening. I learned that most of the people I knew were broke. People who made $100,000 were spending $110,000, while people who made $50,000 were spending $55,000, and so forth. Everyone was spending more than they earned, and credit cards made it all possible. Honestly, I don't think things have gotten better for most people over the past decade. Just more debt and higher interest rates. Now people are facing something I struggled with 10 years ago. After struggling for nearly 2 years to run my office and digging myself into an ironic financial pit, I broke. I was at an all-time low as I was months behind on my mortgage, wasn't able to pay my car payments, and was always struggling to pay my bills. The subconscious poverty mindset was laid down in cement for me. So I caution people about falling into this poverty or woe is me mindset right now. Now is the time to act, even when all things seem lost. Otherwise, you may end up in a state of sadness, depression, or inaction that is incredibly difficult to break free. That happened to me a decade ago, with several similar experiences as I started my new companies. Only recently I found the poverty mindset has been replaced with a mindset of abundance, and now I haven't worried about my finances in several years. Sadly, I'm still not financially rich, but definitely not broke either. After years of stressing about how I was going to pay my bills, make rent, or even feed myself, it has been a significant relief. It took a lot of inner work and effort to get to this point, but honestly, it was worth every bit of the journey, even the worst parts. While working in finance, my bills were outrageous, as I was paying for a house, a shared office, a rental home, a car, insurances, investment deposits, and I only had one tenant renting a room in my house, which was located out of state. I was making practically nothing, and my bills were over $3,000 per month. Hardly an excellent place to be if you are a financial advisor. It may have been my pride, but I persisted through the struggles, burning through all of my savings. There was an all-is-lost month, not a moment, but a month, where I just didn't know what I was going to do. Today, I feel many people are going through this all-is-lost month right now. It was crippling and debilitating. I didn't want to go to the office, as I didn't want to face the other people in the office. However, we are being forced to do this today. It made me feel like a failure, despite all my previous efforts. I had only taken Sundays off, as I held events every Saturday. I still kept going to the gym and social events, hoping that something would manifest. It just so happened that it did, because I had faith it would work out. It just wasn't how I expected or wanted it. I didn't want to end up broke and struggling before the miracle happened, but it would be one of the best learning experiences of my life. Now I'm glad to have those experiences as tools to avoid ever ending up in that place again. At the end of my all-is-lost month, I was offered a job working for one of the most revolutionary privately owned retirement firms in the country. That was the stability I needed at that time. It was through my connections at the gym I went to daily that I received the job offer. My persistence paid off, not with clients, but with a better job. It was wholly unexpected, but because I had a Series 65 financial license, he was particularly interested in bringing me aboard. He offered me everything I could have asked for, and I took him up on the offer. Leaving my office and my team of financial planners, I moved on to greener pastures. The decision to move on was difficult and invigorating at the same time. My new boss taught me how to find all the hidden fees, tricks, and scams that investment vehicles use, which put retirees at risk. I was confident that he was genuinely doing the best thing for his clients, as he gave out most of his education for free. If you search retirement planning online, odds are his videos will pop up first. We were compensated when educated people used us to invest, which happened quite often. The boss even showed me how to tear apart investment vehicles that I used to sell at my old office. I couldn't believe the hidden fees and lack of clear disclosures that most of the investment vehicles contain. It was even more eye-opening when he told me about the hidden fees and hidden catch inside the investment product that I had put my parents into. I even hired my dad into the previous company to teach him about finance, and we still never knew the hidden catch. There were things that people just aren't being taught, including the advisors. So when I had this new opportunity to talk to people all across the country and spend hours a day educating them about what they have, I was in heaven. It felt like a calling. I felt like I was helping so many people and even helped to better educate my dad on how the products work. While I'm not saying all investment vehicles are bad, I'm saying that most people, even the people who sell them, don't know exactly what they are buying or selling. This lack of financial literacy is why we had the 2008 collapse, which is still leading into the current economic meltdown. But more on that later. I initially started in finance to educate people on simple principles like the Rule of 72 and how to start to save for retirement. Now I was discovering that there was really only one safe investment for most retirees. The reason was because most safe investments like government bonds, savings bonds, or certificates of deposits, CDs, don't return enough interest. And now with interest rates dropping to 0%, it means that retirees are even more screwed, to put it lightly. The problem then is, if safe investments don't have high enough returns, what else can you do? I could recommend the next level up would be high-grade corporate bonds, real estate investment trusts, or bond funds. These all have much higher payouts. The problems are with the risks. Currently, we have been seeing big bubbles burst in tech and housing. However, these aren't even the biggest looming bubbles. That was when my boss put things into perspective, and he would illustrate it as such. Investments that are low risk earn about 0.5% to 1%. Few retirees can survive on such low rates. These include government bonds, certificates of deposits, and savings bonds. The risks are very low because of FDIC insurance and other protective measures. However, banks are currently leveraged 9 to 1. Bill Gross, the bond king, said 10 years ago the U.S. government is $100 trillion in debt. So will those protective measures still continue to protect us? And here's the math. U.S. government unfunded liabilities, according to usdebtclock.org, on 4/19 of 2020, Social Security was $20.4 trillion, Medicare was $31.5 trillion, U.S. debt was $24.4 trillion, and other total unfunded liabilities were $144 trillion, totaling in at over $200 trillion in unfunded liabilities. And on top of that, the bank's fractional reserve banking simplified. You put $100,000 into the bank, banks can lend out $900,000 in return to its customers. Should banks be allowed to create so much money out of thin air? More on that later. Medium risk investments earn about 2 to 6%. They include high-grade corporate bonds, real estate investment trusts, probably have the highest returns right now, and bond funds. The risks are medium to high risk because of, default risk, interest rate risk, properties defaulting, businesses going bankrupt, but bondholders do get paid before stockholders, and there's no government protections. The math here is bond fund risks. If interest rates go up 1%, bond funds will lose up to 5% in value. However, bond risks and individual bonds offer no interest rate risks if the bonds are held to maturity. However, if a company defaults and files for bankruptcy, you will be one of the first to receive a payout. REITs, or real estate investment trusts, are risky because the properties they manage could default, foreclose, or go bankrupt, easily affected by a crash. The high-risk investments, you can lose 100% of your investment, and you really have no limit to the market as long as it keeps going up, because they anticipate it keeps going up forever. Really? Well, the types include mutual funds, stocks, low-grade corporate junk bonds, BC grade, derivatives, and the risks with these are high to very high because stocks and mutual funds can crash, and we've seen unprecedented crashes these days. Business bankruptcy means likely a complete loss. Derivatives and related mutual funds are leveraged 32 to 1, and there's definitely no government protections. Stock risks. Stock prices can crash, can lose all money, but can also go up for massive gains. Mutual funds, same as stocks, the market can destroy 100% of savings during a crash. However, because of diversification, you won't lose big if only a few companies fall. Some funds have high fees and rarely outperform the market when comparing performance. Derivatives, these are scary because if you buy $100,000 of Apple stock, the company can create and sell $3.2 million, yes, $3.2 million in soon-to-be worthless paper investments. I hope you caught the last one about derivatives. Warren Buffett, one of the wealthiest investors on the planet, described derivatives as financial weapons of mass destruction. I completely understand when you understand a simple principle. Just like the banks can lend out 9 times what they have in deposits, hence the term fractional reserve banking, they only have to keep a fraction of the money in the bank or on hand because they have discovered how to create money infinitely. The investment banks using derivatives can leverage up to 32 times. This means that for every $100,000 in assets these investment banks have, they are lending out up to $3.2 million. And yes, that's millions of dollars to ignorant investors, which is one huge reason I'm writing this paper. The derivative market is a bubble of which we have never seen, and one huge reason I left finance. Since the top 10 banks have over $500 trillion in derivatives, it's probably something that we as a society should understand. Considering the global domestic product, GDP, is only 85 trillion. The global GDP, yes, is only 85 trillion. Considering that if everyone cashed out of the system, there would only be 3.125% of the money left over, which should scare most people. And the math on that is 100% divided by 32 times leverage equals 3.125 principal amount. Thank you for listening. Please like or share this video so that others may benefit from the information contained. Have a great day.